Good morning, ladies and gentlemen. Today is December 3rd, Saturday. Hope you guys all had a great week. Very interesting week in the markets with the Fed, Jerome Powell coming out suggesting they are going to potentially start altering the rate increases depending on data. And I'm interpreting that as what I've been telling you for the past couple months is that the Fed could still raise rates quarter point, half a point, maybe 3/4 of a point still, but become more data dependent. The Fed has raised rates considerably over the past few months, really from near zero to close to 4% right now. And the markets are shifting, as we're aware. What I still believe is taking place is what I call the great unwinding of excesses or the unraveling of excesses throughout the global market. What we're really seeing, ladies and gentlemen, is over the past 10 or 12 years, and I'll summarize, the global markets, foreign markets, have gorged themselves on cheap U.S. debt and credit. So essentially borrowing U.S. dollars, and the way I explain it to everyone, it's very simple. If you can borrow U.S. dollars at 1.5% or 2%, convert them into your foreign currency, pick a currency, any currency, deploy that in a cheap commodity market with a relatively substantial U.S. Fed base, meaning the quantitative easing and support by the U.S. Fed, turn around and take that 2% U.S. dollar loan, flip it in a business environment for 10, 12, 15%, maybe more in profit, and continue to, satisfy your debts, repay your debts, and continue to flip this money like a carry trade over and over and over again. It gets real easy to get trapped into an environment where you can take excess credit, excess debt, because it's very cheap, it's very easy. I mean, who in their right mind wouldn't want to take, $200 million worth of debt, theoretically, to turn around and flip that into $1 billion worth of profit? But what happened back over here in the excess phase of the 2021 rally phase is everything got very expensive and consumers started to pull away. So you started to see commodities go up, energy go up, raw materials go up, labor go up, and revenues decrease. At the same point in time, you had these concerns globally about what's going on in the U.S. markets and the Fed telegraphing that they were going to start raising rates. So now you've got a bunch of these foreign nations and corporations that are hundreds of millions of dollars potentially in debt, at either through bonds or direct loans, and they're seeing weaker demand for their products, and they're seeing increased commodity prices, which in some cases were 400, 500, 600% or more. So that carry trade, that borrow U.S. dollars at 2% to try to make 12, 14, 15%, all of a sudden became, look, we're not making a lot of money. Our margins have collapsed down to maybe 4 or 5 or 6% or less. Our costs have gone through the roof, meaning cost of raw materials, copper, cement, lumber, what have you, have gone up 3, 4, 500%. So now with margins contracting, consumers contracting and not spending, huge amounts of debt on the idea that they were going to be able to carry this trade forward, borrow at 2%, flip it for 15%. Now they're borrowing at 2%, flipping it for maybe break even, but they have these debt satisfaction issues. Now they either have to repay the debt to get out from under it, or they have to borrow at a new higher rate, call it 6, 7, 8%. In order to satisfy their scenario. But their margins have contracted considerably. So this is a scenario where globally, what I believe is really happening is we're seeing the early stages of this global contraction right here. This is obviously the S&P 500. But we're going to see potentially more unwinding of these global excesses over the next couple months and possibly through the rest of 2023. What will eventually happen, in my opinion, I'm going to drag this over and flatten this down. These are lines that I drew many, many months ago. And you can see from back over in this area, we have a potential for some sort of extended wave 4 contraction back down here. I remember I've been talking about the beginning of a wave 5 rally that will send us up into new highs. That is eventually going to happen, ladies and gentlemen. We are flagging out, and I will show this to you in another chart, but we are flagging out into this sideways pattern, and where we're headed right now is into essentially a malaise. We're going to move into a sideways pattern, which gives us some opportunity, but we don't have any real confirmation of an uptrend or a downtrend. Many people are talking about the fact that the U.S. market is going to collapse. There's far too many people out there, who I call them the doom and gloomers, that are saying that the entire system is going to collapse. What I see is maybe something different. What I see is the excesses of the global world, excluding the U.S., particularly at this point, are going to continue to unwind. And that's going to be a commodity and an asset price revaluation event throughout the world. Meaning that homes, expectations, consumer demand, consumer engagement, corporate profits, tax revenues, things of this nature are going to be restructured and reevaluated over the next 2, maybe 3 years. But it's going to become a bigger event, in my opinion, in foreign markets than in the U.S., which is why I believe the U.S. markets may continue to move through this cycle, possibly into 2023, possibly bottoming back down in this area. It will not be a massive collapse. It will be an orderly collapse if it happens at all. There's another side to this story, which is, and I will just duplicate this real quick, which is duplicate, that the U.S. market enters into a global safe haven strategy, which could prompt a move back up to upside, current upside, new highs, let's call them. And then this becomes negated. And this entire unraveling phase of the U.S. market becomes negated. And that's where I'm leaning right now, given the fact that we've seen a strong impulse buying, speculative, some would call it speculative. I'm going to call it impulse buying. It is traders getting back into the U.S. market, expecting the U.S. markets to recover. I believe the U.S. markets are somewhat immune from the global risks. Yes, there is a chance of default, and it could be some sort of a contagion event. We will know more in 2023 for Q1, Q2, Q3. But right now, it looks like it's fairly immune, and it looks like the U.S. market is attempting to break away from these highs right now and trying to get up into this area here, proving that a wave 5 base is starting and we could continue to move higher. If a wave 5 base does start, these purple and red lines are going to be key target areas. It's going to be 4,600 on the S&P and 4,400 on the S&P. And will they happen before the end of the year? I doubt it. That's only a couple of weeks away. Could we see some continued melt up into 4,300, 4,400? Yeah, we probably could, especially if there's some real positive data coming out. For example, if the Fed were to come out with a quarter or 50-point discussion related to the next rate increase, that would be considered dovish. That would possibly send the U.S. markets into a bit of a rally phase, and we could move a couple hundred points fairly easily on the S&P. But in reality, ladies and gentlemen, it's this contagion event, this sideways basing pattern. So you can see we've got this downward cycle trend. We're very close to this area right now. This puts, again, just like last week, it's telling us that we have very strong concern that it's either going to attempt to break higher or move sideways back down into this area, this lower support channel right here, this yellow line, and try to flag back out, which I believe is highly likely going into Q1. But I believe Q1 data is going to be fairly strong. I believe the U.S. economy is still clicking away. I believe houses will continue to melt downward over the next 6 to 12 months. Remember, that's not something that happens instantly. There is no massive crash. I want you to understand, if you're believing the housing market is going to collapse, pay attention to the data. Just over 40% of all mortgages in the United States, or let's put it this way, of all homeowners in the United States have completely paid off their homes. They're owned clear and free. That means about 57% are carrying mortgages, and probably 65% of those are already locked in at 2.5%, maybe 3%, very low rates. It's what's going to happen over the next 6 to 12 months with foreclosures and at-risk market that's going to be very interesting. And that's going to be a longer term play. So understand that housing, if you really think that, the wheels are falling off the trend, you need to slow down and think that this is a longer term play, and we need to see how this plays out with the Fed, how this plays out globally, and what the U.S. market does in comparison to global markets. And I am a firm believer right now that the U.S. market is acting as a safe haven asset resource for global markets. Cryptos have imploded. Housing overseas has gotten a little sideways. Risks are elevated overseas. Commodities prices have come back down for the most part, but consumer demand is still waning. COVID is becoming an issue. I just heard today in LA, or actually yesterday, that we've gone back up into orange level in LA, where COVID cases are rising and could go into red, which means we go back into mask mandates and potential other issues. So we have a lot of issues coming, but the U.S. markets are uniquely operating as an asset safe haven for the foreign markets. The U.S. dollar strength above 100, 104. I really think it's going to stay above like 102, 104 and waffle around between, say, 102, 104 on the low side to possibly 106, 107 on the high side. Maybe even spike a little higher if some sort of a global event takes place, meaning foreign market event where money rushes into the U.S. dollar as a safe haven. But the fact that the U.S. dollar is strong, U.S. assets are strong, companies in the U.S. are still earning money, Fed is moving potentially into a dovish standpoint, and the U.S. markets are acting as a global safe haven, leads me to believe that we are going to see some sort of a melt up over the next 6 to 12 months, maybe back into this range here, 45, 46, 4,700, before we maybe attempt to move into that wave 5 rally. Now, I will add the caveat that there still is risk for, extended war in Ukraine, disruption in global markets, some kind of a crisis event, even another COVID lockdown or COVID crisis could send the U.S. markets into turmoil. So we're in what I believe is an early wave 5 base bottom mode, attempting to break out to the upside. We do not have confirmation of this yet. My calls have been perfect with regards to the bottoming and the move in metals and protecting our assets since August of 2021. Now I'm warning you that we're moving into an area where we could get some mixed triggers. We have to stay cautious at this point. There are some opportunities. I will tell you that there are some opportunities setting up, but we still need to manage our expectations. We're in a downtrend. We're sliding sideways. We're flagging out in this formation. We've got a very big A, B, C, D, and now we potentially could come into an E pattern here, but I'm counting more on this rally to the peak, coming down to A, B, C, D, flagging out here and trying to break to the upside. That's what I see is ultimately what is going to happen. The U.S. market will continue to operate as a global safe haven, and I'm calling this Predator Fed, and I've mentioned it before, I've talked about it, but I believe that the Fed, the U.S. Federal Reserve, has inadvertently set up a massive global foreign market crisis event where the unwinding of the cheap U.S. dollars that were provided for almost 10 plus years after the 2008-2009 global financial crisis have created a deluge, kind of like a dam bursting of crisis for foreign market entities and governments. They have so much cheap money debt that now having to deal with the Fed at 4.5%, 5% Fed funds rate compared to where we were at 0.25%, presents a huge crisis. They need to unwind all of this debt that they have at very cheap rates. They either need to repay it, restructure it, or roll it over into new debt at rates that are, 14,000% higher. And that's what we're looking at. So this unwinding of debt excesses throughout the rest of the world could take another 2 or 3 years. But what it does as the U.S. market is somewhat immune from this debt crisis. It still has its own issues, but it's not the same as these overseas countries and entities, corporations trying to unwind this super volatile debt crisis. Assets are dumping into the U.S. market as a safe haven, as the best economy on the planet. It's somewhat immune from these debt unwinding processes. And this is why we're seeing the U.S. markets hold up much better than the global markets, and why we may see continued upward trending in the U.S. market. Even though the global markets may be in some form of crisis mode or unwinding or sideways downward trending, the U.S. markets are somewhat immune to it. They are acting as a safe haven. We still have a strong economy. We've moved into a new decade or two of a transitional period. Remember, a lot of people don't understand this. Every 20, 25 years or so, we go through a massive cycle shift where, the kids that were born over the last 20, 25 years now start to move into their working, earning, saving, investing phase. So right now, as we are at 2023, I want to tell you that those kids that were born in 1980 to 2005 roughly are moving into buying a home, earning, saving, investing, and we have a huge number of those people in the United States that are already moving into this 25 to 45 year range, and they are the primary drivers of consumption. They are the primary drivers of economic activity, and 90% roughly of them are already working. They're saving, they're investing, they're putting away in their 401k. And unless something happens to derail the U.S. economy substantially, this type of attrition in the background is going to continue to drive investment in U.S. equities and U.S. stocks, potentially even into foreign assets once they base and bottom. Now, I've carried on this because I want to show you what's happening over here with the custom index charts. I know this is a little long, but it's very important. We're going to start with the cash flow index. The custom cash flow index has moved higher again. You can see that cash is piling into the U.S. markets right now. This is telling you that we're getting a very solid impulse buying start, potentially of wave 4. We've broken through this trend. I will warn you that we have this upper channel, should have drawn a line across here, but that we're going to run into some resistance around 160, 1.60, 1.65, probably run into some resistance up here. But that gives us, again, another 11, 12% higher potentially before we run into some resistance. But we're getting very solid confirmation of an uptrend right now, and the fact that retail is buying, institutions are buying, and this is a very solid upward trend indicating that the U.S. markets are finding some upward momentum right now. Remember my earlier warning, so I don't want you to be confused, and I'm going to go over this here before we get to the end. Remind me. Next, we have the consumer engagement chart. The consumer engagement chart for November was pretty ugly. I mentioned this to you earlier. And now we're getting a little upward blip in December. I do expect consumer engagement to move back out here and flatten out. So that means that we would be over here, the 0.164 roughly area where I'm pointing. I believe that consumers are going to re-engage. They're going to have their Christmas. They're going to make it work. Prices are starting to come back down. Food prices are in moderation a little bit. Energy prices, oh my gosh, out here in California for a while you couldn't find gas under $6. We now have certain areas where gas prices are now in the 420, 430, 440 area, and we can't wait to see it back in the 370 area. That would be almost a 40% decrease in gas prices out here in California, which is tremendous. But this consumer mechanism here is very, very important. We do not get rallies. We do not get GDP growth. We will not have economic strength if the consumer continues to stay weaker. We need to see consumers come back into this game and start playing and actually investing. I believe that's going to happen more along the lines of January, February, March. It's going to be pretty well flat with a little bit of a melt up, in my opinion, as far as the U.S. markets. But consumers will not start to engage until probably February, March, when we have some clarity as to what's going on in the actual U.S. and global markets. So that means we have 60, 90 days of concern left. It may present some opportunities, but we need to be aware that we're just not having that consumer fuel. Think of consumers as the fuel that drives the economy. If you understand GDP, consumers make up nearly 70% of total gross domestic product. So if consumers are not engaging, consumers are not spending, and they're not buying, GDP is going to be weaker and the economy is going to be weaker. So this is something we watch for, as well as transportation. Transportation is a measure of how engaged consumers are, how much they're spending, what the expectations are for consumer engagement related to transportation and shipping costs. Okay, so here we are. We're kind of finding some support in the first couple of days of December. I expect it to get back up into this area, 0.164, 0.165, and stall back out. So kind of right back over into this area. Next, we have the large cap index trying to base and bottom. We've had a fairly substantial decrease here. In fact, we've probably seen one of the biggest decreases since this 2012 or 2008 area. Ideally, the unwinding in the U.S. markets has been very substantial already, 30, 40% in some cases, 50, 60, 70% in other cases, for example, innovation and the ARC funds. As I've been warning you, and remember, a lot of what I do is longer term, so this is a monthly chart, and we're basically looking at a stagnation into December where large cap indexes may attempt to move a little bit higher, start to prep a momentum-based bottom for early 2023, and we're looking very good right now as the potential for this to happen. We don't have any catalyst for any big unwinding. So right now, on the horizon, as I mentioned to you before, I don't see anything huge that's going to disrupt the market. We could have a couple of minor things. We could have, war in Ukraine, what have you. But as far as the U.S. goes, it's a separate beast. It's operating almost on its own planet right now, in the sense that the U.S. economy is doing what it's doing. We're having a little bit of employment issues. The numbers were a bit mixed. But the other numbers, the economic numbers, are still coming in relatively strong. And like I said, if we shift into a renewed consumer engagement in 2023, even if houses and other assets continue to unwind, we could see a moderate melt up in the U.S. markets, which is what I'm expecting right now. The global asset index is trying to hold up like the large cap index. We've seen a fairly solid unwinding. We are, like I said, consolidating down here near extreme lows. We are in a downtrend. We are not seeing any real upward global asset moves yet. We are seeing a bit of a base and a bottom setup, but nothing really confirming. The custom gold cycle index is doing exactly what we kind of expected. We had a little bit of accumulation taking place, which is what I envision this as. Understand that this is early stage accumulation. This is accumulation in a rally phase, chasing price. This is distribution, early distribution in a topping pattern. This is distribution in a downward cycle phase. So we're in an early accumulation phase still. And holding up down here near these low levels is still early accumulation. We've already gone through a distribution phase, meaning lower prices and people wanting out. How can I tell that this is accumulation? Well, prices have been going up. This has not started to move up. We're not seeing the chasing of a rally phase yet, which is what we saw here and here. We are in early stage accumulation for precious metals. It's a great time to get positioned for what's going to happen over the next 2, 3, 4, 5 years plus. This is exactly what we look for as gold bugs. We want to be buyers down in this early stage accumulation, or back over here, because this is where we get the rally phase, and this is where we can begin to start offloading for big profits. Now, in this case, you buy back over here at 1,300 and you sell back over here at 2,000. You buy back over here at 1,550, you sell back over here at 2,000. You buy back over here at 1,680, 1,640, you sell back over here at 2,200. That's the idea behind understanding gold and precious metal cycles. There's always that early accumulation phase, and that's what this chart's good at showing us. When it's basing and bottoming here, we look for early stage accumulation, upward price movements in gold, silver, platinum. We look for it to start to base and bottom. Then we look for the breakout trend. The breakout trend starts a price appreciation phase. This is where we sit and let our profits start to accumulate. And then once we move into this early distribution phase here, that's where we want to try to look to get out. So when we get up above this 70, 80, 90 phase and we start to see this distribution, this is where we want to try to lock in some profits, get out efficiently as possible, and move into the next accumulation phase. These are longer cycle phases. Understand each one of these, for the most part, is about 2.5 to 3.5 years. Next, we have the custom market timing. And this is inverted from the last one I showed you last week. Up top, we have the S&P 500. Down below here, we have my custom cash flow index phase, showing you the cycle phases that are taking place. And then here we have the market timing index. This is a weekly chart. The weekly chart on the custom market timing fear index has continued to move back into this lower stage, meaning we're not seeing fear, ladies and gentlemen. If this continues to weaken, remember this is inverted. So you can see here 1492 down here and 590 over here. Fear comes in as we start to see traders really begin to fear the downside rotation. We saw it back over here with COVID. We saw it back over here near the top. The green line is what I call my initial fear index. The yellow line is where we get into moderate fear, and the red line is extreme fear. We've gotten all the way past all of those, back into moderate, no fear. At this point, people are expecting, in my opinion, based on this data, expecting a moderate melt up, some calm, some recovery, some upward melt up trending. You can see that the cash flow index has started to move higher as well. So we're seeing this upward trending, and my belief is we have about another 12% to go back up into this area on the S&P. And that would put us at about 4,400. Now, will it happen before the end of the year? I don't know. I'd say 50-50. Where will we be there by February, March of next year? I strongly believe that we will have tagged this level, maybe a bit higher, and then rolled back down into a consolidation phase just before Q1 earnings hit in April. So understand that March is going to be possibly a bit of a stagnation of people unsure what earnings are going to be. I think Q1 earnings are going to be fairly strong next year. So again, we're getting that cash flow index consolidation, confirmation, we're getting the hooks up technically. We're getting the moderate lack of fear back into real trending mode. What we need to see here is that breakout to the upside to move away from this consolidation downward trending, and a move up above 4,200, 4,300 on the S&P would do it. Okay, so that'd be 420, 430 on the SPY, and we're getting very close. That's what I think the melt up at the end of the year is going to be. It's going to be a melt up into the end of the year, a little bit of consolidation into early January, maybe till the 10th or 15th. Or so, and then I think we're going to be looking at Q1 numbers and Q4 numbers a bit, depending on what Q4 2022 looks like and what we see guidance for 2023. Remember, weaker guidance is not horrible. Like I said, if I made $23 million last year, and this year I'm expecting to make 21.2. And quarter over quarter, I'm still profitable. What's happening is we're seeing a downturn in the market. Earnings will contract. Earnings expectations will contract until they start expanding again. So when you start looking at earnings, just like last quarter's earnings, 80, probably 89, maybe 91% of all earnings were positive. We're beating expectations and we're revising slightly downward. So understand that, you're going to hear a lot of fear. You're going to hear a lot of doom and gloomers. And that may come from foreign market analysts. I know that, a lot of people up in Canada are seeing the world in a different scope because of where they live and what's happening, and are really more doom and gloomers. But the whole scenario here is that I think the U.S. market is in a totally different environment. And if we focus on the U.S. market, and we're not talking about Europe or China or Asia or South America or Canada or Mexico, when we're talking just strictly U.S. market, it really is a totally different beast right now. And Predator Fed, as I told you before, has done an excellent job of setting this up. We'll see how it plays out, but they've done an excellent job of setting this up. And essentially, the strength in the U.S. consumer is still relatively strong. What everybody didn't understand over the past 15, 24 months is that this is not 2008. We have seen increases in wealth, increases in earnings, increases in the economy, strength in the economy, strength in consumers. I mean, think about it this way. If housing prices were to drop 50% right now from where they're at right now and just overnight drop, yeah, it would be pretty ugly, but I guarantee you that 70% roughly of homeowners in the U.S. would still be profitable in their investment in the home. And again, close to 45% of them have their home completely paid off. So they don't have to worry about a mortgage. Most of these people have already locked in super low rates, so they may only be paying, $1,000, $2,000 a month for a home right now. And as long as they have a continued job and income and savings, they can afford it. That's the difference of what's going on in the market right now, is that a lot of people don't realize over the last 4 or 5 years, there's been a tremendous wealth accumulation in the U.S. People are able to ride things out differently than 2008, 2009. Okay, the custom tech ratio index, basing and bottoming. Remember last week and the week before I mentioned to you that the technology index could be a really good early stage buy trigger. I warned you to not be aggressive about it. Just basically take a little position in it if you wanted to. Stick with things that are, that are consistent. Amazon, hypothetically, Microsoft, maybe eBay, maybe Etsy. Stick with things that are less exposed to litigation and other issues, especially with this big Twitter thing that went on yesterday. But anyway, technology looks very strong. I still believe we could have a reversion here over the next 12 months, a nice 30, 40, maybe even 50% reversion trade back up here to the upside. Understand, from where we were up here at 65, we've seen a 55, 60% decrease. So now we're down at 30. In order to see a 50% increase, we only have to get back up here to this 45 level right here. So this is, again, a very good opportunity for you to start dipping your toes in what I would call staging positions. In other words, don't bet the farm. Don't go crazy. This is a scenario where maybe you are looking at a small investment, picking up some real opportunity in these deeply undervalued tech and innovation companies, waiting to see what happens over the next couple of years. And this is really something that should be very, very small. I don't know how to explain it any other way. These are like dipping your toe in the water, not jumping in head first. But so far, it's looking good. It's basing, and I'll show you over here on the FANGs index why it's looking pretty good. Now, the U.S. custom U.S. to global market index, you can see the U.S. market index here is just barely trying to scoot outside of this range. Be very important to see how this plays out throughout the end of the year, whether we get a melt up, whether we get a false breakout or whether we get some trending. The actual global markets have moved outside of this trend already. So the global markets are showing that there is some recovery phase in this. You can see from back down here off the COVID lows, we've already rallied from a negative 7% up to an 11% range. This is 17 roughly percent upside move in the global markets. We've seen the same type of move here in the U.S. side, down here from 40% up to about 61. That's about a 10% rally phase. Now we need to see how this plays out. Is this going to continue to rally into Q1, or is this going to move up and slide sideways into a basing pattern? So be prepared. We're kind of at that mode where this could be a false move. This could be a tagging of a resistance area. We need to see how this plays out, and volatility over the next 3 weeks is normally pretty weak. So between now and January 15th, understand that, do not expect very big bars. Do not expect a lot of volume. Unless something really critical happens, the markets are going to want to slide into what I call a bias trend, which I believe is going to be a melt-up trend. But right now, we're getting kind of that early stage, sideways, possible melt-up, and risks are still fairly elevated for some type of a contraction move before the end of the year. We could see it just completely go flat, completely sideways, maybe roll back lower 5, 6, 7% if some sort of an event takes place. The U.S. Custom Valuations Trend Index is starting to show some positive signs. This is something I really want you to focus on. We need to see this really start to trend in order to have some real upward potential. We cannot have the markets, U.S. markets, move higher, substantially higher, with any type of real momentum until we see this valuations trend index start to move higher as well. And you can see here after 2014, 15, 16, well, 14, we had a move up. 15, end of 14 into 15, 16, we went sideways. End of 16, we went higher. 17, 18, we went downward. This was a melt up. Remember, in 2017, 16, we had the elections. Then we had this basing 2018. Then we started a very solid upward valuations trend. This is a move that shows underlying momentum in the actual rally phase. Notice the rally phase carried all the way over here into 2020, late 2020, and then in early 2021, we started to see this devaluation phase, which meant that traders were essentially pulling out of assets and staying cautious during that 2021 phase. Now we've got back down into a bottoming phase. Looks like we're finding some support. Looks like we could start to move into a rally phase here. We will see. But right now, we're getting just an early stage basing, which is good to see. I would like to see it move back up into this 2.0 level. That would say that we would carry us into Q1 and Q2 of 2023 fairly efficiently. But right now, we're not seeing it. We are getting early stage bottoming basing formation, but no real momentum follow through to the upside. Next, we have the U.S. leading index chart. And this again shows us that we're seeing very solid upward trending. I want you to be aware that we have tagged these middle standard deviation areas. This is a great bottom that I called about 2 months ago. Really, that was the low. It looks like we're getting this big impulse move like we saw back over here. We're already back up into this upper channeling area. Ladies and gentlemen, if this continues to follow through, we are going to see a melt up. This is a very good confirmation of a melt-up trending through the end of the year and into January. We have broken these channels. We have a long way to go to get back up to this 2.60 level, and that could prompt a 15, 20% rally in the U.S. markets. But let's not get ahead of ourselves because the other charts are not really showing us that we have much strength. Next, we have the volume ratio index. Volume ratio index is showing moderate accumulation in a flattening volume period. That's to be expected around Christmas. Understand that every time right around Christmas, we typically get a little flattening period and try to highlight them right in here. This is where we're at in flattening periods. Again, this was COVID. Then we have the Christmas time here in 2020. Then we have Christmas back over here in 2021. and then we had the big reversion of trend. This was the very first indication that sellers outnumbered buyers by a massive amount. We have not seen that. We're seeing buyers outnumber sellers by a fairly strong amount, and we're getting fairly strong accumulation with volume here. Very solid confirmation that we might continue to see our upward melt-up trend like I'm expecting. The commodity to gold index, I highlighted this with some arrows here. We've seen in the past fairly strong recoveries from these lower areas back up into this 3 or 4 area, from this COVID low back up into this 3 or 4, and then eventually super high during the commodity cycle. Right now, we're like I said, I think we're more in a wait and see through 2023 mode, meaning we'll melt up, we'll trend higher, potentially, unless something breaks our trend, but I would be very cautious back up here in the, say, 2.2 to 3.0 area. I would say that we aren't going to see the same type of recovery rally here. Fed raising interest rates, totally different market, totally different Fed. I think we're going to see a more moderate upward trend. When we get into 1.8, 2.0, 2.2, 2.3, again, I would start to become fairly cautious in these areas depending on what's going on with the world. We could still see it melt up into the 3, 3.5, 4 area, but again, I'm trying to stay moderately cautious here until my rotational modeling system really gives us any confirmation. We're getting good signs of an uptrend. We're just not getting in my rotational modeling system to really confirm it. Okay, metals. Back to the metals chart. So why was I talking about accumulation during this phase? Very important to understand that real accumulation was taking place during this sell-off. What was happening back here was that we were in a downward cycle. We were in a cycle where other assets were more attractive than metals, and there was really no fear. We hadn't seen the global markets really start to contract. Now we've gotten a shift. We've got a very clean shift in metals. It's going back up. It's formed a solid bottom. We're seeing real accumulation now with an upward price trending in metals. And this could be the next big phase to set us up here for a new high. So this next accumulation phase, and it'll continue to do this, ladies and gentlemen, setting up these new higher lows and higher highs through this accumulation phase over the next 12 to 24 months, possibly before we enter into the parabolic phase. The parabolic phase is like we saw between 2008 and 2011, where metals skyrocket. They'll go up 600-700% from a parabolic phase, which is why everyone, believe it or not, everyone who's talking about 9,000, 10,000, 12,000 gold is basically saying that the new 1,800, 2,000 level, this area where we've been with gold, could become the new momentum base for a 600% rally, which would put us at $10,000, $12,000 gold. Same thing with silver. 22, 23 could become the momentum base for a potential 700, 800% rally, which would put us at $160, $170 an ounce silver. So again, very solid move in silver and gold, big break up to the upside, very strong accumulation. Again, you've got a great opportunity here because we're going to see this potentially move up like we did here from 7 to 10,000, consolidate. Back down here to 8,700, back up here to 12,000, back down here to 10,000. So when we really consider the move, hypothetically, from, call it 8,700 to 2,700 or 12,700, it's a $4,000 move. This was a $4,000 move, hypothetically, from 7,000 to 10,000. So from 10,000 up, we'd be looking at around 14,000 as the next target peak. Then we'll rotate back down to around 12,000 or 12,500, then start to move higher again. This is very early stage accumulation in metals, and I hope you understand this could be a great opportunity if you understand what's coming over the next 5+ years. Custom FANGs index. This was, again, one of the bases for why I told you back in this area that initial positions in the technology FANGs index could be very, very good. We're getting that basing. We're getting that flagging. We've got a very solid fractal formation here. Back down here near these extreme lows, you can see this lower channel. I believe that we're going to get a nice little pop here in the technology sector, possibly up 25, 35% back into this area in early 2021, meaning the first 6 months or so of 2021. Technology is going to continue to earn, folks. I don't know how to say it any other way. They've got themselves set up where Amazon, Microsoft, and others are in the cloud services. Technology firms are going to be here. Yeah, there might be some variances in what they earn and how they earn, but they've got themselves set up as a very solid earner. And I don't believe that technology is going to dissipate substantially like we saw with the 2008 or the dot-com crisis. I believe this has been a substantial pullback from 240 to 120, that actually below. That's about a 55, 60% pullback in the FANGs index. And I believe standard deviation channels will put us back up into this 170, 180 range fairly quickly in 2023. When I say fairly quickly, I'm saying probably by the second half of 2023, unless something derails the global economy and the reversion process. I fully believe this reversion back into a 50% area right in this area is highly likely next year. Remember, the global debt issue will settle. The unwinding will settle. The federal global central banks will do their best to keep the wheels on the train. Unless something happens to completely unravel the global economy, a reversion trade is very, very likely at this point. Okay, custom metals index. This is more tied to real metals prices. And you can see the basing, bottoming, the triple bottom. Now remember, back here, I really thought that this was going to be our base and our low. This was our big washout distribution low, which really was accumulation taking place down here near these levels. Now we're back into the upside, upward trending. Gold and silver need to get above this level right here in this custom metals index chart. So let's call that 410. The reality, ladies and gentlemen, is if we can get above this level on a new rally phase, then I can confidently tell you that metals are attempting a new rally mode and to get back into this yellow brick road, I call it, right here, these yellow channels. That'll put this index moving higher by more than, do the math real quick, by more than 22% back up into this area. And that's going to be a substantial move. You know, imagine gold's at 1,800. 20% of 1,800 would be $360 higher. That would put us at about 2160. If I do the math right, that would be back near all-time highs. Silver would be back up above near 30. And that's exactly what we're looking for metals to start to move into a new accumulation phase, a new rally phase. So here we go. We're just running into this resistance here. We could stall out a little bit depending on how fear is setting up, but this critical price high, this Fibonacci price high is very, very important. We've broken this channel. We've broken back above the support channel. Now we have to get above this level here to see any type of upward movement. Everything else is positive, but we need to get above this level. If we can't get above this level, then be cautious. We could see some sideways rotation, potentially reattempting almost like a head and shoulders. So here you have the left shoulder, here's the head, and we could form a right shoulder over here before going higher. Next, we have the Smart Cash Index. This is the global index. You can see we're moving higher. I pointed out this gap area right here. We have to get above this gap in the global index, the Smart Cash Index, to see it move higher. In reality, this becomes a fairly big resistance zone. It's right below this key double resistance or support zone here that carries over. So understand, I do expect it to try to move higher. I do expect it to try to get back up into the pre-COVID levels in 2023. But I'm telling you that we could run into some resistance near the end of the year right in this area. We could see it rally for a week, maybe 15 days, 20 days. Then by the end of the year, roll over and see some sort of a false downside move before attempting to move higher. So be aware, we're in that kind of fragile uptrend, but we still have some real key resistance levels to get above. Moving on to the U.S. stock market index, very solid flagging. I really wanted to highlight this purple line and this little pink line here. We're getting this sideways flagging, and by my count, we are 1, 2, 3, 4, 5 looking to try to break out. We could see some volatility here. We could see a false low back down into this pink or this blue line area, meaning we could see about a 7%, 6% downside move on a false selling phase in the markets. But we are very, very close to what I believe is a solid win, a real solid win, guys. So be aware that I really believe that this is going to turn into a big wave 5 rally. And I mentioned it to you before. The U.S. markets are very uniquely positioned. Everybody keeps missing this. Unless the Fed does something to really break the back of the global markets and the U.S. markets, the U.S. markets will likely revert back up into this 1300 area, right below all-time highs throughout 2023 and maybe early 2024. I don't expect a massive rally. I expect a melt-up rally of about 15 to 20% from these levels. And I think that's, nope. Custom valuations index, valuations has moved higher. I can show this line here across this high. We've actually started a new solid uptrend. This means that stock market is now accumulating and increasing in value. That's good for the upward trend. We want to see this happen. We are now very near resistance in this area. This has been historical resistance. You can see it normally kind of stalls in this area before it tends to move up. We could see a bit of a stalling here, 2, 3, 4, 5 weeks of stalling, sideways melt up with no real trend before it moves higher. But we are in a totally different mode. We have completely unwound the excesses of COVID, and now we are starting to see a bit of an upward trend. We need to see how this plays out, but it's looking good so far. And of course, the volatility index has moved back up to 11.19. We are in this area where we are trying to break away from this downward channel. You can see this downward channel here from the peaks back over here in 2018. I cannot tell you how big this is from a structural content. Okay, just strictly structural. We entered into a downward cycle phase in this cycle. We've continued in this cycle phase. We've technically been in a downward cycle phase since 2018. And I need you to understand it. It's hard to understand that we've been in a downward cycle phase since 2018, but we've seen rallies taking place since then. Yep, I get it. It doesn't make any sense, but we are now at a point where we might be breaking away from that downward cycle phase and attempting to re-enter a new upward cycle phase, which we'll have to check out. If we get above this 12-14 area and find some real support back above this blue level, then we could see a very strong melt up in the U.S. markets over the next 12 to 24 months. But now on the converse side, if this stalls next week and pulls back down into this 8, 9, 10 level or lower, understand that that would still be moderately bullish. That would still be a reversion. It would still be technically considered okay. We're in moderately strong. I call this, if think of it as a speed gauge, 0 to 100. If this were a speed gauge, I would say that right now we're pushing 55, 65 on the speed gauge, bullish. Okay, we're not up here near 100 or 85. We're in the 55, 65 range. If we were to come back down here to 8, that would put us in the 25, 35 range, hypothetically. If we were to get down here below 6, then, ladies and gentlemen, we're now looking bearish, looking for more bearish downside activity. Where we're at right now is in the 55, 65 speedometer bullish range. We would love to see this continue to break out higher. I'm guessing a 50-50 chance it may, but I also believe there's a 50% chance that we're going to come back down into this 8 area before the end of the year, reestablish a new base, and then really start to take off in January 2023. So there you have it for the custom index charts. I've gone over what I believe is likely to happen in the U.S. markets, why the U.S. markets are acting the way they are. And be aware that really, unless there's some big impetus, we're likely to slide into a melt-up period for the next 5-6 weeks with moderate volume. Then I believe once we have an idea of what Christmas was like and the New Year's and Q4 was like, I really believe that's when we're going to start to see a really strong melt up back into this 4600 area. And these two areas right here really is where I'm expecting. I was going to show you this on the fib charts. Where is it? There it is. Nope, not there. So this was my modeling system, and my modeling system, this is daily. This is what I call my ADL modeling system. So you can see here, this is kind of a line I drew based on what's likely to happen. 43.96, maybe by December 21st through the end of the year. Maybe. So understand that that would be and let me get this from where we're at right now. Now, this is why I think it's interesting with so many doom and gloomers. It's really interesting to see everybody predicting it's going to go down. And then, last week was horrible. Right over here, I watched some guy predict the entire market was going to tank and predicted, 3,200 on the S&P or the SPY. And oh my gosh, it just shot straight up and what a mess. But anyway, long and short of it is let's just go to a reasonable number. That's about 7% melt up higher before the end of the year. And that would put us at maybe on the S&P 4350 to 4365, which would be on the SPY would be 436. Sorry, 430, let's call it 434 to 436 is a comfortable upside melt up for the SPY going forward through the end of the year. And you can see what that puts us is retesting this high here. And that is going to give us a fairly comfortable basing pattern. Understand that if we were to retest this high, move up here by the end of the year, consolidate into early January, and then attempt to move higher. Ladies and gentlemen, breaking this high is critical based on Fibonacci price theory. We've already broken this high. We need to get above this high. There's a little intermittent high here, which we're already above. In theory, ladies and gentlemen, we've broken 1, 2, 3 intermediate highs, 1, 2, 3 standout highs. We are in an uptrend. This is a short-term uptrend. We are moving higher. We are trending higher. And this 4,300 to 4,400 level on the SPY is really the next target, in my opinion, to the upside. Just remember, it's going to be a moderate melt up. So if I were to, try to draw what I think is going to happen, I would tell you that it's going to be more like this. Possibly before the end of the year, kind of a melt up, pull back, melt up, pull back, melt up, pull back, maybe 43.20, maybe 43.40. But I think we're going to tag a little bit above this level probably and then stall back out and slide sideways till January 15th or 20th. Okay, guys, I'm going on to my next video. Follow me on Twitter. Follow me on YouTube. Remember, go to MENT.com, create your accounts. Share these videos with your friends. If you find these valuable, if you see what I'm doing is helping you, and wait till you see the momentum reversal signal. Oh my gosh, the MENT rotational modeling system. The MENT rotational modeling system, believe it or not, is about to turn bullish for 2022. If we see this melt upward over the next couple of weeks and before the end of the year, that we could see the rotational modeling system actually go from a -6%, was I think its lowest point throughout 2022, to actually being bullish. While, get this, 90% of all hedge funds and managed accounts throughout the world are going to be -20 to -40% or more for this year. So boy, oh boy, it's just, let me go find it and show you. It's just incredible. So right here, right here, we are at minus 0.60 for the year. It's climbing back. It's doing wonderful. And this is the momentum, the rotational modeling system ended as of November, the end of November. So I didn't include the beginning of December yet. But oh my God, if you can see this here, ladies and gentlemen, it's actually going up over here on the right side where the S&P is going down. It's incredible that this system is doing what it's doing. And really, I need you to understand, this is the basis. This is the strength of everything that we do. This is what tells us how we're going to allocate our assets, where we're looking for opportunity. And what this is designed to do is mirror the S&P in uptrends and then become more aggressive in downtrends, which is why it's able to make money in this downtrend while the rest of the funds are losing money. That's one of the biggest strengths of your subscription, and what I'm doing for you is not only does this actually work, but it protects your retirement account, allows you to grow your assets while you're trying to trade. All right, guys, that's it. So please share it with your friends. Leave comments. Tell me how I'm doing. Tell me what you would want me to improve on, and we will go from there. Thanks again, guys. Talk to you later.